Kia ora, welcome everybody. I'm delighted today to be joined by Adam Myers. Adam Myers is the Executive Director and Head of Distribution at Pengana Capital, based in Sydney. He is also the Responsible Investment Specialist and helps drive Pengana's responsible investment agenda across their business and various strategies. Adam, welcome.
Thanks, Matt. Appreciate the opportunity.
So we've got a few questions I wanted to run through with Adam with a responsible investment focus, and hopefully we can also bring through some of the solutions that Pengana has in this space as well. So Adam, RI seems to be growing globally. What are you seeing happening in Australia?
Thanks, Matt. I think Australia is very much in line. Probably one of the best places to look for information and statistics about this kind of growth is the Responsible Investment Association produce an annual benchmark report. And in their 2021 report, they indicated that well over 40% of all professionally managed assets are now managed according to some sort of responsible framework. And it has been a steady march higher. I think in 2019, it was a little over 30%. I also saw an interesting stat in an investment trends report recently, which basically said that 8 out of 10 Australians either already invest or plan to invest in responsible or ESG options. And just as a side point, something that I found quite interesting in that report is that it's not the millennials that are driving this demand. It's the retirees and the pre-retirees. But having said all of this, I do want to caution against lumping all responsible investment strategies under the same umbrella. The differences in approaches are often very, very large, too large to be spoken about as a single grouping. If you think about a strategy that excludes tobacco and controversial weapons, that probably has very little in common with an impact strategy. But when you are reading, the reports from surveys or having conversations like these, they're often all grouped together, and I think that can be misleading.
So when you look at, and certainly from your experience, what do you think are the main drivers for the trends in growth that you describe in Australia?
So I think COVID was a major wake-up, and so were all the natural disasters. There have been droughts and bushfires, and more recently floods here. In the US, they've had droughts and bushfires too. There's been massive flooding in China and Europe. I think virtually everywhere in the world, there has been a reference to a worst on record natural disaster. I think social issues have also become increasingly prominent. We've had Me Too and Black Lives Matter and major protests and unrest in different parts of the world. Paris and Hong Kong leap to mind, but you can even think about what's going on in Iran at the moment. I think technology has also played a part. It no longer feels as if solutions are impossible, so we need to bury our heads in the sand and pretend that the problems don't exist. Technology has now advanced to the point that it feels as if there is a real pathway. And I think that's critically important because people are investing behind that.
Do you think that there is a bit of a disconnect between what fund managers are providing and what investors are requiring or, demanding?
I think that depends. On carbon, I think that fund managers are probably meeting the investor requirements. Carbon is interesting because it's a high priority issue. And and it's relatively easy to measure. A unit of carbon is a unit of carbon, so it fits very nicely into fund manager models. On social issues, I'm less convinced, and I think maybe that's because social issues are harder to quantify. Exclusions are generally quite easy. In most cases, fund managers will rely on external agencies to monitor the activities of companies and their exclusion lists. So the prerequisite there is that these agencies screen for the particular issues, and most of the top priorities are well covered. If you go one level down to the nuances, there's probably a little bit more complexity in monitoring those.
Given that more and more investors are demanding or starting to allocate to responsible investing, is there anything that investors should be aware of? Are there any sort of warning signs that they should be mindful of?
Well, look, greenwashing is the obvious one. I think we're all aware of this issue, and fortunately, the regulators are fast catching on as well, but there are still lots of shades of grey. I often refer to the Dow Jones Sustainability Index, which holds the full spectrum of sin stocks. I suspect that some investors in products that track this index may be surprised, but it's not unique to Dow Jones. It's just a convenient example. But I also think there's lots of confusion. It's confusing when there's no regulations, but in many cases, the regulations are equally confusing. The lack of consistent methodologies across service providers is also very confusing. Think about this. We use credit ratings to understand financial stability. And the ratings between major credit rating providers are 99% correlated. And that's because we know what good looks like in this space. The average correlation across major providers of ESG ratings is in the 50s. And that's because we're still trying to work out what constitutes good ESG. And that adds to the complexity. I think a good example is Tesla being kicked out of the S&P 500 ESG index and Exxon being included. Tesla is certainly not a corporate paragon of virtue, but it's hard to imagine that Exxon is a more suitable alternative for this index. And guess what? Tesla is the second biggest weighting in MSCI's equivalent index. And on top of everything else, there's been an explosion of offerings as all the Johnny-come-latelys see responsible funds as a way to make a quick buck or protect fees, etc. So that is a very long answer. So I guess I'll summarize by saying that my view is be careful about passive, but be careful about active too. The claims, the ESG claims that fund managers make really need to be scrutinized, perhaps even more than claims about other aspects of the investment process.
Thanks, Adam. If we look at the last 12 months, by and large, it's been a tough period of performance for responsible investment leaning funds. What are you seeing, and what do you think have been the major drivers in the short term?
Look, it's a spectrum. The lighter green investments have largely done okay. If you're in one of those ESG funds that are holding oil stocks and weapons manufacturers, your performance has probably been in line with the broader indices, maybe slightly better. But the more you tend towards impact, the worse your performance has been. And we can explain this in terms of the risk factors. Growth has been a major headwind, as we've seen this rotation to value. The most impactful businesses are agents of change, which are by definition going to be growthy. And size has also been a headwind. The funds that are more focused on impact tend to have minimum thresholds for the amount of impact that a company must generate. This is obviously adjusted for company size. Or for the percentage of total revenue that must be impact related. And the higher that threshold is, the more the bigger companies end up being excluded. And so the really impactful funds end up with a smaller and mid-cap focus. And as we know, in a risk-off environment, liquidity dries up and smaller companies are invariably harder hit. But on the flip side, when calm returns, these are the companies that often rebound the fastest.
And long term, you still think, maybe you just touch on the long-term drivers and whether you still think that they're intact.
I think they're completely intact, unless we're going to throw up our hands and say we accept a world which is going to be 3 degrees warmer and increasingly unequal. There really isn't an alternative. I'm going to talk more about the darker green funds, but if you think about the clarity from an investment perspective and the stimulus that has been provided from the Inflation Reduction Act in the US, or more broadly, if you think about the commitments to net zero, these are massive longer-term tailwinds. Think about the reorganization that is required to achieve net zero across a whole economy. That's reorganizing transport, energy, food systems, how we make things, what our houses are like, how we heat and cool them, and all the other initiatives, some massive, some small, that are required to achieve net zero. That is the magnitude of the longer term tailwind for the companies that are enabling this transition. But it is long-term stuff, so you need to have a long-term investment horizon. And in choppy markets, people often become quite short-sighted.
Thank you. So Pengana has a history of investing responsibly. Just wondered if you could take a few moments to highlight a couple of the approaches taken by your fund managers, and also sort of focus on what they're looking to achieve.
Okay, cool. As you said, we take ESG very seriously, and most of our products are positioned at different points on that spectrum that I keep on harping on about. So you asked for a couple of examples. I'll start with our International Ethical Fund. This fund has negative screens, so it filters out all the nasties, but the underlying approach seeks to identify companies that are dynamically improving. And one of the areas that they really focus on is ESG. So Axiom investors who manage this fund out of the US, they don't look at the ESG darlings because from a valuation perspective, there is often a premium that is already built into the price, an ESG premium, because other managers are looking at these companies too. So they look to buy companies with ESG potential. And then hopefully as this potential is unlocked and they engage and vote and help to unlock this potential, they will capture the value. It's a very interesting strategy. It's a very active strategy. And then at the other end of the spectrum, we have the Pengana Web Sustainable Impact Fund. This is managed by a UK-based boutique, which is entirely focused on sustainability. So they invest at the very pointy end of the dark green spectrum. To your question about what are they trying to achieve, they actually have a dual objective, which is to advance sustainability and to create prosperity. So all the investments in the portfolio will derive the bulk of their revenue from producing goods or services to address sustainability challenges. These challenges may be either environmental or social. And lastly, to really give more meaning to this approach, they also very comprehensively measure and report on their impact. But as I said, all of our funds integrate ESG, and most have industries that they avoid on ethical grounds.
Adam, that's great. Thank you very much for your time today.
Awesome. Thanks for the opportunity.